Good morning, everyone. Welcome to this update for global stocks and commodities for the 1st of December. And now that we've closed out the month of November, it was yet another gain in America and pretty much around the world as well. So, despite all the concerns about all the things, trade wars and what have you, slowing economies, the stock market continues to look ahead, sees what it thinks is the bottom in the economic cycle, and is pushing shares up accordingly in a very low interest rate environment, and that's pretty much the long and the short of it. All right, in this update, the commentary remains negative, and I guess will probably continue to be that way. We've got obviously a US election at the end of next year, and the trade war may reach some sort of phase one deal, but it's certainly not going to conclude for many, many years, if not decades. But look, the reality is that in America, 5 of the last 6 months have produced gains. So against that backdrop of very negative commentary and very negative sentiment, the market has just continued to grind higher. There'll be the normal stock and commodity trend updates, although admittedly hardly any movement in any of those areas at all last week. And Portfolio Analyst, we looked at a really exciting sector that's really starting to open up and get a lot more attention from the market now, and that's water and wastewater treatment. Technology, particularly digital technology and financial technology, has been stealing the limelight for the last 5 years, and will continue to do extremely well and be front and center, I think, in investors' minds. But there's no question that the drivers for the water treatment sector are very strong and are going to remain strong, and so that's an incredibly important opportunity that is opening up. And it also covered some entry techniques for high growth stocks for the longer term. And anyone that's in Portfolio Analyst knows that we've got a 10-bagger portfolio which is in operation there. So American stocks higher by 31 points, which was 1% across the week. And this is a very broad-based rally. So if you think that this is just Amazon and Facebook and a handful of others, then think again, because the Russell 2000 set new 52-week highs. The advanced decline line is still rising. This is a very broad-based rally, which is very encouraging. What is happening, of course, in America is that the market continuing to rise as it has is raising people's net worth, at least the people that have assets in the stock market. And the consumer is spending as a consequence of that. And because the consumer represents about 70% of the American GDP, then that's very positive for the American economy. So certainly the strategy that Trump has pursued is certainly working. A lot of people would disagree with a lot of his social policy, but if you focus just on the economy, it's probably going as well as it ever has been, considering how late we are in the cycle. There's also a shortage of housing continuing to build in America, so it's quite a positive outlook for the housing market as well, which is important. Now, the S&P overall, the index is starting to get up there now in terms of valuation. There's a forward PE of 17.6, which is not cheap. But we've got to remember, this is against a backdrop of incredibly low interest rates, and that is not something that you can dismiss. So people that are looking at things like the Cape-Shiller index and saying, well, you know, it's expensive on a 10-year view, are completely missing the point. 10 years ago, interest rates, even 5 years ago, interest rates were incredibly different to now. And all valuations of assets are relative to interest rates, to the risk-free rate. I mean, that's just how it works. So to say that the market is expensive just on long-term basis is just cherry-picking the data for your own purposes. So it's certainly probably fairly fully valued, but we've still got some really good growth opportunities in America, and certainly in Australia as well. The other point that some people continue to raise with me from time to time is, what about impeachment? What will that do to the US stock market? My firm view is probably very little. And it's probably quite unlikely to happen for a start. But secondly, this is really an issue that's of great importance to the Democrats, but probably to not too many other people. It's just not of interest to most Americans. They're interested in jobs and wages and things of that nature. And all this impeachment talk is just a sideshow in my view. So if you're worried about that, then I'd suggest you stop doing it. The US dollar finished flat at 98.27, and the yield was also pretty much the same at 1.78%. So let's take a look at a few charts. And we'll start with the monthly chart, long term. So this is the bottom in 2009. And you can see on a big picture level, which is what investors should be looking at, it's not really been a problem. We were down for a couple of months in the last half of last year when the Fed tried to raise interest rates and tried to do it too quickly. Now that they've backed away from that, there's really nothing that's holding the market back. And you've really got to question if you've been defensive or if you've been worried about the market turning over and going into a bear market, then you've just got to wait until we get to a circumstance where the fundamentals would dictate that. And so far, as I've been saying for several years, the fundamental that's required, which is exuberance in the market, which is excessive overvaluation, lots of debt, rising interest rates, all those sort of things that bring the start of a bear market just haven't been in sight. And until they are, then these pullbacks, a couple of months here and there, are really something that shouldn't be worrying investors at all. So that's the big picture. And we're still in this position where there is none of the precursors to a recession, and therefore the start of a bear market are on the horizon. And that's just the fact of the matter. As much as some commentators would like it to be otherwise, it just isn't. There's the S&P on a daily chart, and you can see we're just grinding higher, nothing dramatic. There's no really big range candle days. It's just inching its way forward, pretty much in step with growing earnings. And we'll just check on the Russell. So new 52-week highs. So we're not back at the all-time highs. So this is not as good as the S&P or the Dow or the Nasdaq. However, it is new 52-week highs. So we had all these highs through here from basically earlier in the year, and we've managed to break out. And it's been trending quite nicely since October. So things looking pretty reasonable in America. The dollar, no real change, but still an overall bigger picture uptrend in the US dollar. This is one that I'm watching closely because this is definitely what Donald Trump doesn't want. He doesn't want the US dollar to continue to rise. And so we may see some situations next year where he tries to engineer some dollar weakness, which would obviously be positive for gold and other commodities at that point in time. But so far, he hasn't been successful in getting a weaker dollar. So while I'm here, let's look at the Australian dollar. So we remain in downtrend for obviously because the US dollar is going up, but also because of our own weaknesses in our own economy. All right, so turning to Aussie stocks, the Aussie dollar was down slightly, 67.64. Our index, however, was quite strong, and that surprises me. Not that I'm terribly concerned about the index, as I indicated last week. It just doesn't really come into my thinking, but nevertheless, it still surprises me. I think the banks, the strength in the banks is going to be difficult to maintain, so I don't see the index going too far. But nevertheless, it was up 2% for the week, just for the record. And this is pretty much what I said last week, and I think it's worth recapping on. It's the small cap growth businesses in Australia that have got highly probable and very substantial upside is where investors should focus. You've got to get outside the traditional way of looking at the market, because that was that was yesteryear's story. The situation has changed. You know, the rapid evolution and disruption of older style businesses and technologies is what's occurring these days, and investment approaches have just got to change with that. And in a general market downturn, the best of these smaller and mid-cap growth stocks, they're going to fall less and they're going to recover the quickest. That's just the fact about it. And there's a lot of defensive stocks out there that aren't going to be able to do in a bear market what investors think they're going to do. They're actually going to be quite a trap. So why not go for growth now? Because I think it's growth that's going to protect you, not defensiveness in a bear market. Precious metals, gold didn't change much. It was just up a couple of dollars. Important support around the 1450 is still holding. And I think I know what's holding gold back is definitely the trade matters. And with the expectation of getting some sort of trade deal, at least a phase one trade deal, then that's supporting the US dollar, which is obviously putting downward pressure on gold, but it's also removing the need to have a hedge, the fear of what might happen to the stock market, and therefore people buy gold as a hedge. So those two things are working against gold, and they're overriding what is the seasonally strongest period of the year from November to February is where it's at for gold, and so far that seasonality is just not being able to show through. However, it doesn't take much to for that fear to come back again. GDX is still stuck, hasn't really moved much, and there's not really much else to say there. Let's just quickly look at the charts. I'll just show you the ASX 200. So there we had a tiny little peep on Friday above this resistance level, and we're pretty much at all-time highs. So we've got to go all the way back to 2007. So we've been unable to break out decisively, but we're certainly getting close. Now, if you look at gold on a weekly, we're still getting this longer, more complex wave 4 consolidation, which is quite normal, and we're holding support, and we're still in this quite steep upward sloping channel. So it's still okay for gold, but it certainly needs to hold these levels. And just to finish on GDX, so you can see we're basically just going sideways and have been since September. But it was quite a steep rise. We went from $20.50 in May, at the end of May, almost the start of June, and we got to $30. So we put on 50% in the space of about 3 months. So it won't take much to get GDX moving again. Now, as far as precious metals go, if you want to have a hedge, and I think having a hedge of perhaps 5% or 10% in a portfolio in gold is probably not a bad thing to do for long-term investors, then just decide what sort of percentage hedge you want to have and just hold it and don't worry about the fluctuations. It's just part of having some balance in your portfolio. But basically, if you're more of a trader and you want to make shorter term progress in terms of months, then the sector really lacks momentum at the moment, and you probably should be looking elsewhere if you want to trade something. Other commodities, copper didn't really move, and there's certainly some signs that the demand growth that was expected to come through from 2018 on is probably going to be pushed out a couple of years with the slowing economic growth around the world. So that may be more a 2020 to 2022 story in terms of copper's demand growth, and as a result, the copper price really has done nothing. Crude was down a little bit, but for a change, it was a fairly quiet week. There's the copper chart, so we haven't had change there for quite a few months. And the nickel chart continues to come off the boil, so this big surge here that started in the middle of the year was, of course, as a result of the Indonesian government ban on exports, which they brought forward a couple of years. but now some of that excess froth is coming out of it. But long term, the nickel market looks very good, particularly for batteries, more so than growth in the stainless steel market. So nickel, I think, is still a very, very good long-term outlook, and would certainly be the pick of the base metals. So if you want some exposure to resources, then I would look at some of the some of the more promising Australian nickel stocks. So wrapping it up, sure, markets are overbought, but we've got typically bullish seasonality now into the end of the year. I know the end of 2018 was a shocker. It was probably the worst December in the last 2 decades, but that was because of interest rates, and central banks have just moved right away from that policy now. So there's no reason why December won't take on its normal bullishness for this year. I'd really encourage everybody not to get stuck, and this is one of the reasons that I do this weekly update, is to provide perspective that just helps with decision making. That's really the purpose of this. So don't get stuck with a mindset that you've had for years, or that is commonplace thinking. You've just got to be open to change, because the world is changing very quickly. Everybody knows that, and that means that investment approaches have to change as well. There will be corrections of some sort along the way, but my view of that is, well, so what? That's not a reason to keep you awake at night, or to constantly be trying to jump in and out of the market. It's exceedingly difficult to try and do that on a consistent basis. I really encourage everybody to forget about all the old traditional thinking. There are hundreds of wonderful stocks out there in Australia and America that are going to be far higher in the future, whether that's 3 months, 6 months, or 2 years. Focus on those. There's plenty of them around, and if you don't know how to find them, then hook yourself up with a service or someone that that can help you with that, because there certainly is no shortage of terrific opportunities that aren't outrageously priced. And just don't get stuck on the ones that aren't going to be far higher in the future. And there's plenty of those, and a lot of them are the traditional kind of stocks. Portfolio Analyst this week, I'm going to be introducing a large cap stock this time. Most of the stocks that I look for are small caps, because I'm looking for very high growth and high probability of that growth. And obviously large caps, that's extremely difficult to find. But I'm going to be presenting one that I think is going to be attractive for perhaps investors that are maybe a little bit nervous about small caps. So that's it for this week. There's my contact details for any non-members. The Portfolio Analyst $1 trial for 2 weeks is still available, and I hope that that you take advantage of that if you haven't done so far. That's it for this week. Cheers.